The world is changing faster than ever before. In the past 10 years, there has been an exponential technological evolution, the kind of technology that has revolutionized the world of work as we know it.
The Lawyers Hub was founded on the principle that law needs to interact more with technology, and that greatly affects tech policy as well as access to justice. So the Lawyers Hub exists as a confluence between law and technology, working on tech policy, on emerging technologies, as well as increasing and upskilling the knowledge of lawyers in the area of technology. We support tech startups as well to ensure that the tech ecosystem also engages in policy, but as well understand the issues around data protection, issues that also concern their structure, as well as intellectual property.
If you look at the evolution of technology, it's been relegated as an alternative in most systems. But the realization that the 21st century has brought us into is that technology has to be an integral part of our day-to-day systems. And if you look at some critical technology areas like artificial intelligence, blockchain, nanotechnology, biotechnology, then it gives us a strong indication that if we do not start having discussions on the use of these technology areas, as far as law is concerned, then we may be in some kind of trouble. So lawyers are leading the debate on the use of these technologies, especially in Africa.
Over the years, the Lawyers Hub has supported the innovation ecosystem, convened events such as the Africa Law Tech Festival and the Global Legal Hackathon. The Lawyers Hub has also supported government innovations within the justice sector, as well as trained government institutions and more than 10,000 lawyers across Africa on emerging tech policy.
Our dream at the Lawyers Hub is to have open access to law. We envision a continent where there is access to justice through leveraging technology and with a crowd of enlightened lawyers. We see a continent that also protects its own through better tech policies, that emerging technologies, through its regulation, will offer better value and consumer protection for the people within Kenya and within the African continent. We envision that we will convene policy makers, regulators, as well as lawyers who are more enlightened on emerging technologies and with better digital skills. And we invite you to be a part of this great vision for Kenya and for Africa.
Good afternoon and welcome to the Lawyers Hub. Thank you for joining us today. I can see we have about 360 participants. Thank you. So today we'll be talking about the digital service tax regulations, and the hashtag we will be using for today is hashtag Lawyers Hub Kenya. So feel free to engage us on Twitter and tag us at Lawyers Hub Kenya. We will be joined by our panelists, and to begin, we shall begin by a short presentation from my colleague, Judy, who will set the scene for us on what the regulations hold. So my name is Catherine Moya, and I'm a Tech Policy Fellow at the Lawyers Hub. Thank you and welcome.
So, to think about what KRA could be going for, let's set the scene a bit. There's about 51 million Kenyans. There's then about 41 million of those who are accessing the internet. That's about 91%. Then about 84% of those people are able to access the internet using their mobile phones. It's been reported also that in Kenya, you have about every user, every online purchaser spending about $42. That $42 is now being spent by about 15 million Kenyans who are recorded to having made online purchases. So that's kind of the scope of what's going on here. What's happened so far is in 2019, the Finance Act introduced the digital marketplace supply under the Value Added Tax Act, sorry. It made that amendment to include digital marketplace supply and said that the CS would make regulations to that end. It also made changes to the income tax to record also that there would be digital marketplaces are a place where tax can be drawn from. In the 2020 Finance Act, the digital service tax was introduced as an amendment to the income tax. That was followed by the release of the VAT digital marketplace supply regulations in June of this year, and has now been followed by the release of the income tax digital service tax regulations, sorry. So what we're looking at is a situation where we have a few questions about, you released the previous ones, you released the previous regulations, you've now released these new ones. So what's our expectation? Should we expect that if you qualify as a taxable person under both of these regimes, you're paying both in income tax and under the value added tax? Also, what should we expect when it comes to what's happening with Kenya and the US negotiation? We know that a lot of the digital service providers in this country are American companies. So what should we expect as to fairness of treatment? Are they going to be exempt? Is that exemption part of the policy that we want existing in the taxation space? Further, we know that Africa has signed the AfCFTA, which we know should be launching in 2021. What's going to happen given that now e-commerce further is booming and is growing across the continent? Should we expect that the fair treatment principle that exists in that agreement is going to affect Kenya's ability to levy taxes from the rest of the continent? If you haven't had an opportunity to look at the current regulations in brief, it's a brief document, it's about 6 pages. It introduces, or rather it goes to describe what the digital service tax is. It talks to you about what digital services are, tells you that it includes content that is provided, distributed, and subscribed over the internet, along with other services. So you can imagine your music, your movies, you can imagine even search engine services have been included there, and it's being levied on both resident and non-resident persons, and it's about 1.5% of the transaction value, gross transaction value. So that's your background. I hope this helps to inform where the discussion is going. My name is Judy Morioki, and I am a tech policy assistant at the Lawyers Hub. Thank you and welcome.
So thank you very much, Judy. So as Judy has mentioned, the road to digital taxation began in 2019. And as the Lawyers Hub, we've done a great effort in trying to follow this progression in tax measures as they go along. And in January, we held our first public discussion on digital taxation. And Robert, thank you very much, you were here that time. And since that time, we also held the Africa Tech Festival, where we discussed taxation in Africa, digital taxation in Africa in general. And so we'll be providing a link to our YouTube page where you can actually just see a couple of these webinars that we did before. But recently, when the KRA published the VAT tax regulations, we also did a webinar and we discussed those regulations as well. So now we are here to discuss the final regulations, which are the regulations on the income tax. And as my colleague Judy has tried to put an elaborate, or rather brief presentation of what these laws hold, Robert, I'd like to begin with you. I would like you to introduce yourself, and then the issues that she has raised, I would like you to respond to first of all, I would like you to please, in simple terms, explain to us who is a digital service provider with regards to these regulations, and are they going to be able to pay digital service tax as well, on incomes and on VAT as well. And then you could comment on what you think about the regulations in general and the US FTA and the Africa Trade Agreement. So if you have any questions for our audience, I would like you to just raise your questions in the Q&A so that it's easier for us to follow your questions. If you have any comments, please put the comments in the chat, but raise the questions in the Q&A. You can engage us, as I said, on Twitter with our hashtag @LawyerSHubKenya. So thank you, and Robert, welcome, and introduce yourself, please.
Thank you very much, Catherine, for the opportunity to be part of this discussion. And indeed, like you've given us an overview, these are very interesting developments in the local tax landscape, but certainly not something, it's not new. If you look at it from a global perspective, we've had quite a number of attempts by various countries who have been trying to introduce one form or the other of similar tax. So coming back to a local perspective, we do have the two regulations that have been issued by KRA. One is meant to cover the digital service tax from a VAT perspective, and the other regulations are then meant to cover the same from an income tax perspective. The recently released regulations are meant to cover that from an income tax perspective. So if you're asking who is a digital service provider, I know we have a definition which has been provided by the regulations, which basically appears to cover everyone who is doing one thing or to the other. Name it, if you're downloading content, or meaning you're providing content on the internet, which is downloaded, you are part of that. If you are providing services, let's say podcast or any other education material via the internet, you are part of that. Basically, you might want to say everyone who is going to provide services or who has been providing services via the internet will be covered by these regulations. We also have a very good disclaimer which says that any other regulation or any other service which may be deemed by the commissioner to be part of them will also be part of that. So I don't think, and the intention of the entire framework is to get everyone who is operating in this space to contribute to the tax kitty. And like you've asked, we do have the two regulations. One is meant to cover the income tax, and the other one is the VAT. So the question is, are we then, is it a case of double taxation? Are we then saying that Kenya has decided to push back and I don't know how I'll put it, but try to stifle the operators in the digital space? So one, I think it's good to be clear that from a VAT perspective, the intention is that this tax should not be borne by the service provider. So for instance, if you are saying you're downloading content or you're streaming services from Netflix, Netflix is required to register in Kenya. One, they can either register and operate from their hub, the foreign hub, or they can appoint a representative in Kenya to do that, to file and all, to make sure they are compliant from that perspective in Kenya. That VAT, the 14% they levy, is supposed to be borne by you, the consumer of those services. It's not supposed to be a cost to the service provider. Be it any other, because VAT, the VAT component is meant to apply to non-resident persons. So if you are a resident person or you have a permanent establishment in Kenya, then you are required to register for VAT either way in the absence of the regulations, if your services are within the threshold provided under the VAT Act. But for these non-resident suppliers, that's where we are coming in, and we are saying, let's say you have your company in Kenya and you're providing the same services which Netflix is providing. If your threshold, if your turnover is over and above 5 million, you would ideally be expected to register and pay VAT. But then when Netflix is providing the same service, they will not be charging VAT. What does that mean? Then Netflix has a competitive advantage because their pricing will be less than 14%. So this is coming in to try and streamline and make sure we have a level playing field for both resident operators and non-resident operators who are delivering services or who are providing services to consumers in Kenya. So that should be clear. VAT is not supposed to be a burden to the service provider. It's supposed to be borne by the final consumer. Now, from an income tax perspective, the 1.5% is definitely a cost to the service provider. Now, in such a case, if I go with the same example of Netflix, that means Netflix will be required to pay, let's say if your subscription is worth 1,000 Kenya shillings, 1.5% of that amount is supposed to be paid by KRA, either by appointing an agent who will be doing that on their behalf, or they can either register in Kenya to do that, to make sure they are compliant from a tax perspective. That is a cost to them, and no doubt in the event that they do not have an opportunity to either utilize that from their home country, or either expense that, they might decide to increase the subscription to maybe 1,100 shillings or to 1,100 and a certain amount just to cover for that tax. So that is a cost to them. Now, in terms of the discussions that are going on, We do know they have global discussions at the level of the OECD. They have been trying to come up with one unified approach to make sure that we do know how, we not have a situation where every country is crafting their own regulations to make sure they get a piece of that kitty. So the OECD is supposed to release the final regulations by end of this year. We are not so sure whether this will happen with the COVID, but ideally that was the target. By December, we should have had a unified approach where all countries would adopt that. But then again, we do know it's mainly driven by the developed countries. So it may not address all the expectations of the developing countries. So that could be where probably Kenya and other African countries are coming from. They are not convinced that the solution that will be provided will actually be, will actually represent their challenges. So we do expect something to come through. And like you see, the discussions that are going at Kenya between the US and the trade negotiations, we will wait to see. The US might decide to say that they will not proceed with the discussions until Kenya has put or shelved the plans to introduce that next year. So thank you very much for that. And those are my initial comments. Thank you.
Robert, for those comments. Fred, as you come in, I would like you to introduce yourself, and a few questions are being raised by our audience. And the first is, Fred alluded to the 1.5 gross transaction tax being charged on, let's say, for example, Netflix, and then them having to probably increase their cost from 1,000 to 1,100. And so the question is, does the consumer actually bear the actual end cost of this transaction, given that the regulations do say that the tax would be paid at the point of payment? And then another question that is being raised is, how should taxi hailing companies deal with taxes for individual rides? So for example, these regulations actually differentiate between a digital marketplace provider and a digital service provider. So how do you differentiate the tax that's supposed to be paid by Uber as a company and Uber, the ride drivers? So Fred, welcome.
Thank you very much, Kate. My name is Fred. I'm a tax consultant from Deloitte. So on the first question, just as Robert said, for VAT is basically a consumer tax. So VAT should be borne by the final consumer. But the DST, as it is framed, at least for the local or rather resident service providers, this should be borne by the business itself, because it's form of a withholding tax for the local entities. But now, if we look at the non-resident entities, they have no chance to claim this tax back, so they will eventually bear this tax. So they may seek to pass it to the final consumers by grossing up and making sure that they don't suffer tax. They receive the amount that they would have received regardless of the tax. So what this will end up doing is it will increase the prices for these services. So that, say, if it is, we said Netflix, as it is currently, they're not being taxed in Kenya, but if we introduce this 1.5, and now when you're making your payment to Netflix, you have to withhold the 1.5, they may gross it up so that they end up receiving the same amount that they would have received before. And so that would mean that you, the consumer, you'd bear the difference. So you'll end up paying more for the same services. So basically, this will make the cost of such services higher, and cost of living generally higher, and people may shy away from consuming those services. Then on the second question, you asked about the practicality of, for instance, Uber, how they would administer this tax. So you also alluded to the differentiation in the definition between digital market service provider and digital service provider. So going by the definition in the regulations, and even through, by practicality. So there are two elements in digital services. There's the person who provides the medium through which you buy and sell these services. So that would be the digital market service provider. And then now there's the people, or rather the person providing the actual services through that same means. So to me, Uber is a digital service provider. They provide taxi hailing cabs. I'm not sure about the structure, but of course there's a development of the app. But my understanding is that the app was developed by the same company. So then in that case, Uber is a digital service provider. So if you look at the DST regulations, they say that for non-resident, for instance, Uber, for them to be able to be compliant to these new requirements, they'll have to either appoint a tax representative in Kenya, in absence of which KRA will appoint a tax agent on their behalf. So basically, the responsibility to account for the tax will fall on the tax representative if, for instance, using our example, Uber goes ahead and appoints one, or a tax agent that is appointed by KRA. So on the issue of the tax agents, we're still not sure from, at least from the regulations, we're not sure on who, or rather the kind of companies or individuals the KRA will appoint as tax agents. But just going by the practicality of it, we expect the tax agents to be companies or individuals who have sight of these payments. For instance, banks and mobile money service providers, so that when they remit this money, or rather at the point of remit, because the tax point for DST is at the point of payment of the tax. So then when the agent remits, or rather before the agent remits the money to the digital service provider, then they will need to withhold and remit the DST element to KRA at that point of making the payment. So the practicalities are still not clear until we have sight of who the tax agents are. Then we cannot really with certainty say how it will work out, but based on the regulations that they are, that is what we can project. Thank you.
Thank you so much for your initial comments, Fred. And so I'm liking the discussion and the fact that we have 515 participants so far. So I'd like to launch a poll question at this time to find out where your the type of audience that is joining us. And so you can just be able to answer the question that appears on your screen at this moment. And we just want to get the feeling of the 515 people and just know where you're joining us from and stuff like that. So thank you very much. So this is in progress. Laila, as we prepare to, as we are answering the poll question, Fred has raised an issue on withholding tax and whether or not, and so he's talked about the payment being at the time of the transaction, and a member of our audience has raised a question, and the question is, will those who are registered for turnover tax still be required to pay for the digital tax? And the second question is, will the 1.5 digital tax be offset against the annual tax payable at the end of the year? So I don't want to preempt your answer because I've read the regulations, so I just want to give you the opportunity to respond to these questions as you make your remarks and introduce yourself. Thank you, Leila.
All right, thank you very much, Catherine. Good morning, everybody, the participants, panelists, audience. My name is Leila Latif. I am a lecturer at the University of Nairobi and the co-founder of the Committee of Fiscal Studies, by which we engage in a lot of fiscal law and policy research and advice. So thank you for inviting me to speak today on this important topic of the digital service tax. Now, before I answer the question that you've raised for me, I'd like to clarify a bit of I think the complexities that arise out of this regulation and the Finance Act itself, and the person who has asked this question will then probably be able to find an answer by themselves before we answer it. So just to start off, if you look at the Finance Act, section 12E, right? It goes on to refer to the digital service tax as income on provision of services derived from or accruing in Kenya through a digital marketplace. So it's referring to DST as income. Now, if you look at Regulation 4 of the Digital Service Tax Regulations 2020, it also goes on to say that this is a tax that applies to the income of a resident or a non-resident person. So the legislation, right, is very clear that DST is being referred to as income. And obviously we know the rules that apply to income itself. Now, there is an organization called ATAF, the African Tax Administration Forum, and its objective is basically to inform policy and legislation formulation so that the entire African continent and the African revenue authorities can have one voice when it comes to revenue administration and the collection capacity of African governments. Now, ATAF recently wrote a policy brief on domestic resource mobilization with specific reference to digital service tax in Africa. And it goes on to say that when we want to now apply DST in the African jurisdictions, we should be very careful about the kind of definition we're going to give this form of a tax. And ATAF is telling the African governments, do not refer to DST as an income, or do not also associate it with income tax. Instead, refer to it as either a levy on the supply of certain defined categories of e-services that are charged at a fixed rate and are not creditable. Now, if you look at the Finance Act Section 12E, as well as Regulation 4 of the Digital Service Tax, the definition on DST provided is opposite of what ATAF is asking our governments to do. In fact, DST, now this is to answer the question of the participant, I suppose, basically says that our Kenyan jurisdiction is looking at DST as an advance tax, which is to be set off against income at the end of the fiscal year. So even if you're going to be withholding it, you will be able to offset it at the end of the fiscal year. So here we have the ATAF administration telling us, refer to DST as a definition which is very, very separate from income, so that we will not be able to have the problems of double taxation that may arise at a later stage. But we have the Kenyan government that is now referring to it as an income tax, which is now creditable. So you'll be able to offset it against the income that you're going to pay at the end of the year. Now, obviously, these are unilateral measures, right, taken by the Kenyan government, and other foreign jurisdictions have also taken the initiative to apply the DST, simply because at the OECD level, the Inclusive Framework on Base Erosion and Profit Shifting, the BEPS project, has failed to come up with a consensus on how we're supposed to tax the digital economy and digital business models that have a transnational aspect or perspective to them. Now, unilateral measures will be very acceptable. So as of now, because the OECD has failed to come to a unified acceptance on what should be the digital tax globally, it is permissible for the Kenyan government to come up with these regulations, which are unilateral measures. They're acceptable for now. But once we have the OECD having to start implementing Pillar 1 and Pillar 2, I think these regulations that we have right now will then be redundant, right? Because when we're talking about the digital sphere that is being sought to be taxed by the Kenya Revenue Authority, it's actually taxing a jurisdiction or a digital sphere that is cross-border, cross-jurisdictional, cross-fiscal authorities, especially where non-resident persons are concerned. So the question for me is, we have these regulations, and these regulations are targeting they're applied to the income of resident or non-resident persons whose income is derived from and accrued in Kenya. Now, my question is, it may be possible to be able to attach the income of the residents in Kenya when it comes to the digital services they provide. But what about the non-resident persons? How will the DST be applied to those entities that do not even have a tax nexus with the Kenyan jurisdiction? So these are questions that the regulations, neither does the Finance Act answer for us, right? We do not know what sort of rules we're going to apply to now to tax DST for non-resident persons like Amazon, Facebook, Google, or social media platforms that provide users that basically advertise services on user platforms and generate income out of that, what is the threshold, number one, and what is the approach that we're going to use? So the second issue that comes out of these regulations is on the threshold itself. Now, the UK and other foreign jurisdictions already have a threshold, and these thresholds target transnational, multinational corporations. But our regulations in Kenya target both the local startups in Kenya alongside the foreign, transnational, large multinational corporations. So in the absence of telling us what the threshold to applying the DST for the local startups is it going to be the same with the large multinational corporations, or will there be a distinction? Just like Fred and Robert also mentioned, that you do not want to hurt the consumer because you don't want to have a trickle down effect on the consumer having to end up paying for the DST if the DST marketplace providers and the DSTs, the digital service providers are going to be providing these services, they're going to pass on the cost to the consumer, or where you have local startups that are fresh, that are new, that do not have enough fiscal capacity and fiscal revenue, they are supposed to now have the additional burden of paying the DST. So what is the threshold? The regulations do not tell us that. In the UK, it says about if a local UK resident company is generating income more than £25 million in a year, only then does it apply the 2% digital service tax. But what is the threshold in Kenya? We do not know. And I reiterate to say the threshold should not be the same for the local startups as well as the large multinational corporations. Now, the third aspect, when you look at the definition under Regulation 4 on DST, is again on the issue of tax nexus rules and profit allocation. Now, when we talk about the non-resident person, how are we going to apply the digital service tax? This is complicated, right? We may not see it as complicated from a layman's perspective because we think that, the Kenya Revenue.
It's coming back to you.
Mm-hmm. Why? Thank you. So we seem to have lost Laila, and she was giving us amazing insights. So at this point, I think we would just release the results of the poll as we wait for Laila to reconnect.
Would be able to
she's here. Thank you.
Sorry, pardon me. I don't know what happened.
We had lost you for a second. So in the meantime, we had launched the results of the poll, and we're so amazed to see that we have a majority of lawyers join us and people from the fiscal sector and the digital service providers as well. Oh, and government. So Laila, if you could just continue, please. Thank you.
Brilliant. So basically, my problem was with Regulation 4 of the DST regulations, which simply says that we're going to tax the income of non-resident persons, which income is derived from or accrued from Kenya based on the supply of digital services in the digital marketplace. Now, my question is, how are you going to target the DST on this non-resident person? Because number one, you have to have some sort of a linkage, right? There has to be a tax nexus rule that gives the KRA authority to be able to tax that income. So we talk about permanent establishment, and we've already seen from many discussions taking place, even in Kenya, even globally, the concept of permanent establishment is very, very complex because it does not really take into account the digital marketplace. Now, granted, in 2017, the OECD changed the definition of permanent establishment in its 2017 tax model convention, and also the multilateral instrument under articles 12 to 15 have tried to redefine the concept of permanent establishment. Now, Kenya has signed the MLI, but it has not yet brought it into force. So even as we speak of taxing or applying the DST on non-resident persons, the question of permanent establishment still remains amorphous. How are we going to apply this? Because number one, that non-resident person whom you want to apply the DST to does not only operate in Kenya. Kenya is not only its market jurisdiction for activities. It is basically providing services transnationally. And every nation or every state in which this particular organization or this multinational entity is providing its services has a taxing right over its income or its profit. So this is where the problem of definition comes in. We are referring to the digital service tax as income. And for a company, income is basically the profit it makes. Now, under Pillar 1, we do not have a consensus on how to attach and tax that profit. There are 4 different rules that are coming up, but none of them have a consensus on it. So what is Kenya going to apply? What permanent establishment concept are we going to use to be able to now impose the digital service tax? And then when the BEPS Pillar 1 is being implemented, we will have to definitely go ahead and delete these regulations, because they will then become moot and mundane. But in my opinion now, if Kenya wants to benefit holistically and strategically from taxing the digital economy, it needs to change the definition on digital services. It needs to adopt the definition that ATAF is providing, because when Pillar 1 starts to be implemented, then Kenya will benefit in a double way. The first, it will still be able to attach the profits made by the non-resident person under the formula apportionment rule that Pillar 1 is going to now provide the conditions and criteria for. We would still benefit under that. And secondly, when we change the definition of digital service tax from income to a charge, we would still be able to charge the online activities as long as we don't pass on the cost to the consumer. So ladies and gentlemen, let me just end my presentation here so that we can have a host of questions on how to further go about this process. Thank you.
I think Laila, we're giving you a round of applause here, but thank you very much for your comments. And so we can see that the chat has now fired up and we have 27 questions. I will not ask any more questions, and I will just take their questions at this moment so that we can be able to give our participants a chance to engage with our panelists. And so I don't know who to start with first, but on the chat, I saw a question raised for Robert, but as we find that, there's a question raised. Digital marketplace is basically founded on intangible assets. With this in mind, how will KRA be able to factor in turnover tax? And Robert, you had raised a question, and during your presentation, somebody raised a question on whether this applies to social media influencers as well. And I think you could also answer, will there be definitions on the business done online, or is there a general term for all of these businesses? So maybe you could narrow down on the businesses or the taxable services that are now taxed under these regulations. I think we can take those 3 questions, and as we move on, I'll give you 1 minute, 1.5 to respond so that we can at least try and get through all the questions. Thank you.
Okay, thank you very much for that. And very interesting insights from Leila. So I do agree there's a bit of work to be done, and a very interesting discussion there. So in terms of the questions, I do know in Kenya we do have turnover tax. And I think this is one of the issues that probably should be addressed by KRA. For instance, if I'm a driver, because drivers, those who are operating with Uber, Taxify and all that, they'll be covered by this. So if I'm a driver and my turnover is less than $1 million Kenya shillings in a year, and the turnover tax does not capture that, will I then still be required to account for this? Then that's something we would be seeking from KRA to provide an exemption that for resident persons, then if your turnover is less than 1 million, then you're not required to pay this form of tax. Otherwise, as much as it's an advance tax, when that amount is withheld by the appointed agents, you may not have a leeway of recovering that money. So that's something that KRA should seek to address. In terms of the social media influencers, yes. And yes, for any local social media influencer, by the way, even prior to this, they were still required to pay tax. And I know there has been a confusion in terms of who is required to pay tax in Kenya and not. But if you are any resident person, as long as you're generating income in Kenya, you're still required to pay tax. You file your return at the end of the year, you declare your income, then you account for that tax. So this is just a new way of ensuring that KRA is able actually to know how much money you're earning. So if you have been hiding, this is just an avenue that KRA will actually now be able to compute backwards and establish how much money you're earning. On the third one, the taxable businesses, I mean, looking at the definition of the people who are covered by this, you might want to say it's everyone, as long as you're operating within the space, whether a facilitator, like you might want to say Uber, or the final provider, like the drivers themselves, or talk of Jumia. And we have the Jumia, who is providing the platform, and we have the sellers who are selling the goods. Everyone will be covered by this. The whole question is, whether for you it's an advanced tax or it's a final tax, but a final tax is only for non-residents, otherwise for anyone who is operating within the country, it's just an advanced tax. Thank you.
Thank you. Thank you so much for trying to keep time. Fred, I can see a question raised on installment tax, and I know you talked about this in your article where you discussed the proposed minimum tax in the Finance Act. And so I will raise this question to you. Will we be required to also pay the 4 installment tax if we are paying the 1.5 digital tax monthly? That's one question raised by Patrick. Another question I would like you to answer is the handling of digital money. We can see digital platforms like Uber have now introduced a wallet, I think a digital wallet in which you can upload the money. And so how would you respond to that with regards to the payment now, I think, being made directly to the digital marketplace provider? And the last question was a person who asked, I can't seem to find the question, but the question was, is anyone operating a website now considered to be a digital service provider or a digital marketplace provider, considering platform in the regulations is also is defined to include applications, websites, etc, etc. So one and a half minute as well, so that we can try and run through the questions. Thank you. Please, Fred, please unmute your mic. We can't seem to hear you.
Sorry about that. Thank you very much. So on the first question of the issue of installment tax and whether this will still be payable, to answer that, just to reiterate what Robert said. As Robert said, the introduction of DST doesn't take away the obligation to account for tax as is currently provided for under the Income Tax Act. So that if you're required to register for tax in Kenya, you would still be expected to register for tax and pay tax accordingly. So for the resident companies, just to repeat, this will be just a form of advanced tax, withholding tax. And that's why even if you look at the regulations, services that are already subject to withholding tax under Section 35 of the Income Tax Act are excluded for that reason, so that we avoid subjecting them to advanced tax twice. So to the extent that you derive your income from Kenya, you'd still be required to register for tax in Kenya and pay your installment tax or minimum tax once it comes into force if your minimum tax is lower than installment tax. So you'll still be required to pay your quarterly installment tax and or minimum tax besides the DST if you qualify as either as a digital market place provider or digital service provider. Then on number 2, on the issue of digital money, like the e-wallets and everything. So as I said, we still don't have sight of who the agents will be, but even with digital money, the transactions have to go through an existing channel. I mean, the payments will have to be channeled through a bank, through an account, through existing platforms for transferring this money from from the payer to the recipient. So at the point of remitting this money, KRA would still expect a representative or an agent to be able to have sight of what is leaving Kenya and being paid to the service provider, and then they'll expect the tax to crystallize at that point. Then on your final question, you asked whether this now means that anyone operating a website would be required to account for tax. My answer to that is yes. And then again, just to go back to the regulations, as we can see, we have a definition for both the provider of the marketplace and the provider of the service. So even if you work, or rather your role is only to create that website, you're creating, you're providing the place, the marketplace for people to come and transact. So to that end, you would qualify as a digital market provider, and then you would be required to account for tax. And even if you're offering services through this website that you've created, then again, you'll qualify to be a digital service provider, and you will be required to account for DST. So basically, as the definition says, anything that is, anyone that either provides the channel through which people can interact online, or who provides services and goods through that same channel would be required to account for DST. Thank you very much.
Okay, thank you. So these questions are so many, but we'd like to encourage people to raise live questions. And so if you want to do that, just raise your hand and we'll be able to pick on you. But Laila, I would like to address these questions to you. Who provides checks and balances for the commissioner, with the disclaimer that any other thing they think about will fall under digital service taxation? And then the second question would be one raised by JK, who asks, please address the effects of imposing this tax in relation to foreign investors or partners, and whether, I think you had alluded to this earlier when you talked about the GAFA tax. And so what are your views on having this tax charged annually and even on a capped amount, as opposed to each individual transaction? I think you may have answered this in your presentation. The final question was by Gloria, who had asked, if you could give examples of the other jurisdictions where application of digital service tax has actually been done, and what are their learnings or something like this. But I also saw something that as an academic you would be best to reply, and that is, how would digital service tax, I can't seem to find it, but I read it, how would it affect online writing? And so I would like you to answer that as well. Okay, so 1.5 minutes, Laila.
Okay, all right, thank you so much. And you've asked me so many questions, boom. But I'll try to remember if I can. My memory is not the best. But some of the questions, I think I've been engaging with the audience on the chat box, so I've responded to them. With respect to this one on who would be responsible for the checks and balances, right?
Yes, yes.
Yeah, so checks and balances. I'm actually looking at the regulations right now as we speak, and there's this. There's a section, I think section 8, there's a person required to deduct, account, and remit the digital service tax to the commissioner under these regulations, and they're supposed to do so in accordance with the Tax Procedures Act. Now, if you pull up the Tax Procedures Act, who's the person responsible for these purposes? I think the answer might be there. I'm not aware of it offhand. I have to consult the legislation. But then, see, guys, yeah, this is something very new. And it's something very fresh. The regulations have just been passed. Kenya is also a member of the OECD, the BEPS project. It's also a member of the United Nations Committee on Tax. There are different bodies that are going to be responsible for looking at the checks and balances on how the DST is going to be applied, because again, where you have the non-resident persons involved, it's not just going to be a matter of the Kenyan jurisdiction to be able to apply the checks and balances. It has to be done at a transnational level. And this is where you will have the country, the resident country in which the NRP, the non-resident person is based, will also have to have some form of check, especially if we're going to be looking at profit allocation rules under Pillar 1. Yeah, so we're going to have a host of bodies who are going to be responsible for this. But in as far as the online services are taking place within the Kenyan jurisdiction by resident persons who are located in the Kenyan jurisdiction using the interfaces that are within the Kenyan jurisdictions, then I think the checks and balances to be provided will be with the KRA. When it comes to the online writers, as long as I think my colleagues Fred and Robert would be best placed to also answer this from a practical point of view, but having just interpreted the legislation, as long as you're going to be earning an income, which is consideration for the provision of an online-based service. So if I have contracted Elizabeth or the lady Georgina, whoever asked this question, if I've contracted you to write a novel for me, and we're going to be applying the rules of digitalization on that contract for that novel, meaning that the novel will be available as an e-book or a PDF, right? I'm going to pay you an income based on that. That's not really going to be captured under the digital service tax, in my opinion. It's rather going to be applied on the basis of income tax earned. So it's an income that you are earning. I'm paying you for providing me with services, regardless of it being online or not. It falls within the contractual relationship of a contract provider and a consultant, or a contract provider to a person who wants to write the novel. So I don't think it will involve the DST in that aspect. It will just apply the normal rules of income tax. Now, again, I'll say this with caution, because the definitions provided on what a digital service means, or what a digital marketplace or a digital service provider means, can actually complicate this. Because initially, I think it was Fred who was giving the example of, in his opinion, he felt that Uber can be seen as a domestic service provider, isn't it? I think he says Uber is a domestic service provider. But even if you look at the definition of a digital marketplace provider, I think Uber can also fall within the definition of a DMP as well, because the definitions, in my view, are actually problematic because they're not specific. They do not contain a prescribed criteria on how we're supposed to determine who these providers are. They're quite literal, and they can be interpreted in any way somebody deems fit. Before I answer the next question, again, my view on the digital marketplace provider, the definition provided here, and I want to read it out. It simply says, digital marketplace enables direct interaction between buyers and sellers through a digital marketplace website or online application. Now, when we're talking about direct interaction, does that mean it's excluding intermediaries? And this is where I want to be inclined to agree with Fred when he says Uber would not definitely fall within the definition of a digital marketplace, but a digital service provider, because Uber is an intermediary. But then again, the digital marketplace, if you look at how it has been conceptualized, it's actually telling you that the digital service providers in the digital marketplace envisaged is the business to consumer activities, not business to business. So that the DST is being applied to business to consumers as a business model, not business to business. That's what it means. So again, we're now beginning to see the unfairness of this tax system coming out. Why are we leaving B2B out, and we're now going on to hold accountable for tax purposes B2C? That's something we need to think about. And this is something that I just read right now. And like you said, the academic in me picked this up, and I would want maybe Fred or Robert or any other person to help me understand, is my view or my interpretation of this actually correct, or it's misinformed? The other questions you have, Ms. Sahau, if you could please repeat.
It's okay. I think at this moment the questions are overwhelmingly a lot, and so I would like to invite the panelists to probably type the answers to some of the questions, so that at least we can try and answer all the questions before we leave. But I can see specific questions, and I can see one question that has been puzzling to us as well. And I think, Robert, you tried to answer it at the beginning of the discussion. But the question raised is, if you're charging VAT, is DST also applicable? And so this is someone who is probably confused by the languaging of the regulations, and they really would like a clarification on whether, because another question that was raised was regards to online learning and whether they are also taxable in terms of the DST. And so maybe you could comment on this too. Just two questions now, so you can remember this.
Okay, thank you very much for that. Yeah, so for VAT, maybe just to give an overview, Kenya is one of the few countries which is attempting to tax income generated via the digital platforms from an income tax and a VAT perspective. If, for instance, you look at most of the African countries which have one form or the other of this form of tax, it's largely from an indirect tax perspective. So countries have been hesitant to go both the indirect and the direct tax way. But Kenya appears to be ready to go for both. So for VAT, it's purely, you'll be acting as an agent. So for anyone who is a resident person, there's nothing, you will not got to do anything. If you ought to have registered for VAT before the regulations came into place, you should register for VAT under the normal regulations, the VAT Act. This is from a VAT, it's only meant to affect non-resident persons. These are people who you are competing with, and previously or prior to the regulations coming into force, there was no avenue for them to register for VAT. So they were probably making revenues of, let's say, 20 million in Kenya, but there's no VAT, there's no avenue for them to register for VAT, meaning they had a bit of a competitive advantage in terms of their pricing because the 14% was not part of their costing. Whereas for you, if you are local and your turnover was above 5 million, or you had even voluntarily ought to decided to register, you had to charge the 14%. So this in a way, and if you look at the regulations from a VAT perspective, they are only looking to capture B2C transactions. Basically because, for instance, if I'm getting a service from any non-resident company and they are providing a service to a Kenyan company, we already have a mechanism to account for tax in such a place, meaning if they are providing services to me, I, as a resident company, I'm supposed to account for reverse VAT, meaning there's no, I mean, the addition of the regulations are not adding any value for B2B transactions, but for B2C, meaning they are rendering the services to the final consumer, like to myself, Robert, I do not have to account for VAT. So that's how they are aiming. That's the main objective of the VAT regulations. So if you are local, you have your company, or you're providing services from a local perspective, just follow the normal VAT regulations. This is meant to cover non-resident persons who are providing services via the digital platforms. Now, from an income tax perspective, this is where this affects both non-residents and resident persons. If you are a resident person, consider this to be an advance tax, meaning if you are paying tax at the end of the year, this will be used to offset again the final tax that you ought to have paid, let's say by the 30th April of the following year. So this should not make you worry, or should not worry in any way, unless you have been loss making, meaning this tax will only be carried forward because you will not have a chance of offsetting again the same. In terms of the online, learning providing, this will apply, and I think it's clearly listed there, because what probably the government has realized is that we have very many people who are getting, they are going through the internet to learn, and they are making quite, they are competing against the local institutions here. So what this means is that even those providers, let's say Oxford University is providing online lessons to people who are students in Kenya, they will be required to pay the 1.5%. So probably in terms of the fees that you are paying them, they might want to adjust to account for the 5.5%. They will also be required to pay 14% VAT. Now, the only thing, and which I think is one of the submissions we are making, is the fact that locally, education services are exempt from VAT. Why then do you want to tax the same when provided by a non-resident? That could could increase or raise the cost of education when you're getting them from a non-resident. So from an income tax, that's it, 1.5. From a VAT, there's that disadvantage, the fact that locally, if you're paying your fees to the University of Nairobi, you do not pay VAT. But in this case, when they are being provided by a non-resident via an online platform, they will be required to account for 14% VAT. And the thing is, we do not have a threshold. For a non-resident, you are required to register for VAT, irrespective of how much you're making from Kenya. So if you're only making, let's say, 2 million in a year, you still be required to register for VAT in Kenya under the platform that will be provided. So there's that a bit of a disadvantage for non-residents from a VAT perspective. I think that's it. Is there anything that I've left? Thank you for that.
No.
Thank you.
Thank you. The questions seem to be overwhelmingly a lot. I can see there are also people who've raised their hands and would like to ask a live question. After Fred speaks, I will give an opportunity to about 2 people to ask a live question. And so if you're picked on, please be ready and unmute your mic and speak. But Fred, there are questions that have been raised specifically to you. And one was, please advise on the procedures to withdraw a demand letter issued by KRA. I'm not sure. And then the second question was, and which seems to be a recurring question throughout the discussion, and actually brings brings focus a spotlight on how confused maybe the audience or maybe members of the public might be in the definition between a marketplace and a digital service provider. So definitions, as Laila alluded to, are seemingly confusing and people cannot still understand. So maybe you could shed some light on this for us. Thank you.
Thank you very much, Kate. On your first question, I don't know whether I got you right. I'm just trying to link this to DST. Did you ask the procedure of withdrawing a demand letter by KRA?
Somebody asked that on the chat, but I think you can answer. You could answer that. Like you could type the answer. So just answer the second question.
All right. Okay, but just to mention, I mean, if KRA raises a demand letter, you can only object to it. You either concede and pay, either fully or partly, or totally object to it. And then it will trigger a confirmation from KRA and the process now of appeal and going forward. But now on the second question, someone has asked about the difference between digital marketplace provider and a digital service provider. So per the regulations, and even as the terms may suggest, a digital marketplace provider is the person who provides the platform on which digital goods and services are bought and sold. For instance, someone who develops a website, like let's say the owners of Jumia, in terms of Jumia, the website, what they do is that they develop that marketplace. Then now sellers of goods and services, both tangible and intangible, are now able to interact with their buyers through the website. So in this case, Jumia will be the digital marketplace service provider, in terms of they create that website through which people can buy and sell and interact with the buyers and sellers. And then now the people who are selling their goods and services through the website, now Jumia, are the digital service providers, because they are enabling people to access goods and services through the website. So Jumia, the owners of the website, will earn their commission. And if you look at the regulations, they actually refer to commissions that are payable to digital marketplace providers. And then now, of course, the buyers and the sellers will earn the price of whatever they're selling through the website. Thank you. I hope that answers the question.
Thank you. So I will take a live question from Patrick. Patrick, please, if you could just unmute, and you have less than a minute to ask your question. Are you there? Okay, so you seem not to be there. We will ask Rachel. Rachel, you could ask your question at this moment.
Yeah, thank you, Catherine. I have less than a minute, so I want to be straight. It's good that Fred has given a clarification. The difference between the market, no, he just spoke about the marketplace, the likes of Jumia or Amazon. So Jumia earns a commission, the sellers earn the retail price, or they receive the retail price. So does Jumia remit the 1.5%, or on the retail price? Or do they remit 1.5% on their commission, and then the seller remits 1.5% on retail? And in that case, then there'd be double taxation, because if the item costs 1,000 and the seller pays 1% of 1,000, Jumia earns 100 shillings commission, they pay 1.5, then it means the 100 shillings will be double taxed. So, so that is in the case of Jumia. That's B2C or B2B2C. What about in a case of Shopify? Shopify provides e-commerce platforms, to small businesses. So that's more B2B. But the end users can buy through that. Shopify does not receive the retail whatever income or retail cost of the item. The small business receives that. So how do you treat the Shopify structure of business? Yeah, so I would appreciate that clarification between the Amazon style or Jumia and Shopify. And then can someone just clarify a bit on the digital service provider? Is there a difference? And do we even need to know the difference? Or will, whether you're marketplace or digital service provider, you'll still pay the 1.5? Yeah, thank you.
Okay, thank you.
Hello?
I don't know if Patrick, okay, just Patrick, ask your question. We can see you're here now.
Yeah, first of all, I appreciate the panelists for the wonderful presentation. I'll just dive into my question. I'm an expert in ICT and especially more in the payment system, payment gateway and APIs. When you accumulate the 1.5% and then more into the percentages that the most e-commerce payment platforms charge, let me say, like, for example, iPay, FinServe, I&M and the rest, they range between 2.5 and 3.5% in as far as their charges that they charge. So in total, we are looking at charging a customer 5%. In this case, if these companies want to make a profit, they'll have to mark it up to 7%. So you can imagine the cost that is going to be either endorsed directly to the customer in terms of customer to pay, or in this case, merchant to pay. It's not feasible. We acknowledge that technology overrides the law, but the law regulates the technology. We're willing to want to kill the e-commerce small SMEs and businesses that are coming up. Leila, I appreciate your discussion in regards to putting a threshold in as far as how much we need to charge for the businesses and taxation. Thirdly, I want to thrash the government a bit. Surely and realistically, e-commerce was not highly endorsed back in the days. Amazon and the likes were highly of the caliber back then. Please let us breathe as digital people. Let us breathe in terms of making ourselves earn in the right way. Let us breathe in terms of creating new market space. We have seen new technologies emerging in regards to creation of employment. Let's talk about the Algeria Digital that has been put in place by the government. It is one of their baby. You want to tell? So my point is, sorry, I was not meant to be a panelist, but next time, please consider me because I have a lot of insights within this space. But thank you very much.
Sure.
I appreciate it.
Please share with us your email privately, and we'll be sure to reach out to you. Thank you. And so we'd like Laila, you were mentioned in this conversation, and you seem to share the same sentiments. Probably you should answer Patrick's question, and Fred, you could take the initial questions that were raised. Thank you. Laila?
Yeah. So I'm just gonna that distinction between who pays the digital service tax, yeah. So that's the question I think needs to be very, very clear. I've also gotten a number of people who've written to me privately saying, is there a difference between DST and VAT? Is it the same thing? So firstly, DST is separate from VAT. Even when you're paying the DST, where VAT is applicable, you will still have to pay the additional 14 or 16% VAT. Okay, so they're two separate things. Now, who pays the digital service tax? Simply put, the one who earns the income as a result of providing an online service is the one who's going to pay the digital service tax. So that means the seller, the supplier, as well as the reseller of the digital service or the digital good. That's the thing. When the other question was about the difference between, or is there a difference, or is there no difference between the digital marketplace marketplace provider vis-a-vis the digital service provider, I mean, I still hold the view that it can be interpreted very broadly so that the entire definitions themselves are amorphous. So the way I see it, the digital marketplace provider, for example, could be, for our social media fans, those who use Instagram, we would look at the digital marketplace provider as Instagram itself. The digital service provider would then be, for example, if you have the World Health Organization having an Instagram page, right? Now, when World Health Organization accepts other people like Nike or Apple to advertise their products on its page, then the Apple people, for example, would be the digital service provider on the Instagram digital marketplace provider platform. I mean, that's how I'm beginning to now conceptualize it in my head. So Instagram, all the revenues that it earns, all the income that it has earned would be subject to the DST, as well as now Nike and Apple, who have also been advertising on the Instagram profiles of different people. Whatever revenue they have earned as a result of their online generated revenue from advertisements, they would also have to pay the DST. Now, these are non-resident persons. The question is, how would Kenya Revenue Authority tap that sort of tax when we're not, again, very much clear as the tax nexus rules as well as the profit allocation rules? That's my only concern that I'm having, and I keep reiterating here together with my friend who wants to like thrash the government about it. How are you going to end up doing this from a practical point of view? When it comes to taxing the residents, people who are already located in Kenya and have their internet or digital interfaces within Kenya, applying that tax would not be a problem as long as legislation has been passed, and it has been passed, and it's also going to be automatic whenever you're going to be purchasing services. So if I buy something online, I'm not going to be paying the DST. That's how I see it. Now, the person who's selling me or supplying to me that service, he or she is responsible for paying the DST. That's where I'll let now Fred and Robert come in.
Okay, thank you, Fred and Robert. You've been invited to come in.
Thank you very much, Kate. Just to answer the question on still on who accounts for the tax, especially where we have a combination of both digital marketplace provider and digital service provider. Just let's go by the example of Amazon. So let's say someone purchases an ebook.
We seem to have lost Fred for a minute. And so as we prepare to have him back, Robert, I have seen a question that's asked, and it relates to, so I saw this question earlier. One was numerous questions about cryptocurrency and digital taxation. So I would like you to probably comment on that. I wasn't prepared to raise a question right now, but you could probably comment on that. A second thing was a person who raised an issue on he runs a website, and the website is purely for ad services, and so he does not generate money from these ad services. And I think the question was, how do you tax these platforms? But with the regulations, and I think I want to comment on this, the regulations now in the DST income regulations provide for taxation of incomes of data, however monetized. And so this means if you're going to use our data to generate it for ads or whatever it is that you're going to be doing over the digital marketplace, but you're going to be deriving revenue from that. So I would like you to comment on, probably, there was a question that was asked on how the Data Protection Act affects the implementation of digital service taxes. And so you could comment on that in that light. So thank you.
Okay, thank you very much, Kate, for that. So, yeah, so we certainly know that this whole discussion is in some context being misinterpreted, because I must say that some of the services which have been historically been rendered by resident persons in Kenya, they were actually subject to tax. And so, for instance, someone who was in the cryptocurrency business, if you derived an income and you're a resident person in Kenya, then you ought to have paid tax. The only thing that this is coming in is the fact that KRA is imposing a withholding tax system. And basically because, for instance, we have a case in point, we know Uber. KRA attempted to go to Uber and demanded all the names and the address of all the drivers that are operating under the platform. And Uber said, I mean, they cannot provide that data. Why? Because they do not, I mean, there's the issue of the data protection. And again, there's a whole issue of confidentiality. So KRA definitely did not manage to tax all the drivers. And so this tax is coming in and saying, you see, they'll appoint Uber. And Uber, for instance, giving an example, they might appoint Uber and they'll ask Uber to withhold 1.5% of any payment that they'll be making to these drivers. Now, what KRA will do with this data is the fact that they know driver, if I'm the driver, Robert, 1.5% has been deducted from my income. So at the end of the year, they know exactly how much I have made from Uber. If I'm also serving Taxify and any other platform, they'll have that complete data. So to a resident person, the 1.5% is not an additional tax. If you look at it, it's just an avenue for KRA to make sure they have visibility of how much money you are making from accessing these platforms. It's not an additional tax, it's just a way of ensuring they have your data. And so by the end of the year, they'll be expecting you to declare X amount of income, and they will have confirmation and the proof that that's how much you made. So for anyone operating locally, please consider this not as an additional tax, it's just a way of KRA making sure they have information over how much money you are making. Now, the second one is, you will only be taxed if you are generating income. So if you are providing a certain platform like the website you're saying for ad services on pro bono basis, definitely you'll not be expected to pay any tax because you're not generating income. But the moment you have money coming through to your bank account because of that service, that's now where KRA comes in, and they either appoint an agent to deduct the 1.5 from you, or either require you as a service provider to voluntarily pay the 1.5 on a monthly basis. Again, that will be an advance tax. You still be required to account for the normal income tax at the end of the year. Now, in terms of data protection, you look at it, what KRA is doing is basically what I would call, for local, for resident persons, it's merely an additional withholding tax regime they're introducing. The same way for, let's say if you are paying EY professional fees, KRA requires you to deduct 5% from that fee. So they're not asking you for any additional data about UI. All they want you to do is deduct the 5%. And by doing that, KRA is able to know UI and a certain amount of income from you. That's what they are doing. It's purely a data mining from a local perspective. For non-residents, it's just ensuring that you are not making money in Kenya without being subject to tax. And I know it's an interesting discussion because like Leila is saying, in terms of the international tax rules, we do not have a provision to support that. But I'm also of the view that we cannot hold ourselves back because of international tax rules that were set, I think they have been there for many, many years, and we do know the economy is evolving, and the tax rules must also evolve with that. We know the OECD is doing some work, but we don't know again, and they also appreciate that that's the whole reason behind the revision of the tax law. So if we go with the issue of, let's say, a non-resident must have a permanent establishment in Kenya, we will be losing a lot of money. And again, there's the local protection of the tax base. So there has to be a balance between, must you be located in Kenya, must you have a PE, or can you also offer these services without ever stepping your foot in Kenya, but you also taxed? We need to look at these international tax rules, and we cannot limit ourselves because certain rules were set 20 or 30 years ago. They must be reversed, they might be rewritten and revised to acknowledge the fact that we have achieved in the economy. Thank you.
Thank you so much. And I think I agree with what Robert has said with regards to when we hosted the second webinar and we hosted KRA, they alluded to the fact that already these people are creating value from our economy. And so there was a discussion on whether that matter has to be very urgent. And in the discussion on taxation, whether the taxation has to be urgent or we should just take the time and make sure that we have proper rules and proper definitions or proper sound rules, as Leila is alluding to. And so I'd give Fred the opportunity to finish commenting on the questions that were raised earlier before we now take our final questions and closing remarks from the panelists. Fred?
Thank you, Kate. Sorry about the hiccup. My internet went off. I think I was responding to the issue of the point of taxation in the instance of someone buying an ebook from Amazon. To me, this transaction has two components. There's the marketplace, which is the website, and then there is the item that is subject to DST as listed there as well, the service being provided, which is the supply of that ebook. So the tax point will depend on the instance of payment. So there are two payments to this regard. There's the payment for the ebook, then there's the payment to Amazon for offering the platform for the book to be purchased, to be posted and to be purchased. So in my view, Amazon is offering a marketplace to the seller of the ebook. And to me, to the extent that this seller is not in Kenya, then the DST would not accrue on the payment to Amazon in terms of the commission. But then the payment for the ebook that is being made from Kenya, or rather the consumer in Kenya buying that ebook and making payment to the author or the developer of that ebook, say in the UK, then that payment should be subject to DST. But then now the issue comes at how do you distinguish these two? Because when you're making the payment, an element of that payment will be due to Amazon as commission, so that the payment will capture both the consideration for the ebook and the element that is due to Amazon. But then, so to me, there should be clarification. And in one of the submissions that we're making, we are urging KRA to clearly define user, so that then we know, because this has an impact on the tax point and when and where the tax accrues. So we're saying that KRA should clarify who the user is, because to me here, the user of the digital services being the ebook here in Kenya should only account for DST on the element of the ebook. But then now there's a component of the commission that goes to Amazon, which in my view should not be taxable in Kenya, to the extent that the developer or the seller of that ebook is not in Kenya. So I agree with the attendant in the, to the extent that there may be an element of not really double taxation, but taxing an amount that should not be taxed in Kenya, so to speak. Because to me, the element of commission payable to Amazon should not be taxable in Kenya, to the extent that the seller of the ebook is not resident in Kenya. Thank you.
Thank you so much for your comments. And I think with regards to the DST income regulations, this matter was raised again when we held KRA in the webinar I had just mentioned. And when I read the regulations, they tried to define, to distinguish between the digital marketplace provider who will earn a commission and whose taxation will be subject to that commission, and the digital service provider. So again, the taxation, and that's the taxation being the income earned by the digital service provider. Yeah. So at this point, we're pressed for time. I would like to ask the panelists if it is in your will and in line with your data protection rights, that probably you could, we had close to 30 questions we didn't answer. And so if you would like, or you would like to be pursued further, you could post your email and probably, or your Twitter handle, whichever you think is easier to reach you. And maybe people could engage you later and ask you these questions. Again, we would like to ask the audience to just tweet and remember to tag us and tell us what you learned from this webinar. We can see we had more than 500 people. And so to be cautious of time, we have to take your closing remarks at this point. And with our closing remarks, we'd like to ask each panelist to just concentrate on what recommendations they would have for us. Laila, you had mentioned that pushing the incidents. Okay, so Robert had mentioned an issue of pushing the tax incidents to the consumer. being one of the major considerations of these regulations. Laila, you had also alluded to definitions and the unilateral approach that we're taking, and also how that impacts on multilateral efforts across the continent. I'm so sorry, and so across the continent, and you have been part of that with Tax Justice Network and all the other players that you work with. So I will ask each panelist to just make brief closing remarks, and thank you. So we can begin with you, Laila, for a change.
Yeah, chivalry is not dead. Women first, huh? So I just think I'll just make 4 observations, right? So the regulations are well-intentioned. That's my view. It's trying to create a tax system to be more responsive with digitalization and the digital services that are coming into play within our jurisdiction today. So it's a positive move towards trying to capture this tax so that we can broaden our own domestic resource mobilization in line not only with the Kenya Vision 2020, but with the AU agenda as well. Now, my other issue is that despite having these well-intentioned regulations, they do nothing, absolutely nothing, to address changing the system of international taxing rights across all consumer-facing industries. Because again, this can only be achieved at the international level where all countries are agreed on the type of system that they want to place when it comes to taxing the digital economy. So we have to think about this balance from both perspectives. Importantly, the regulation should go on to clarify this threshold, basically what is the bare minimum below which DST should not be applied. And in determining this threshold, it should be distinguished between foreign multinational enterprises, which are non-resident persons in Kenya. Their threshold should be different from the local startups from the Kenyan jurisdiction itself. This is to provide a competitive edge for our own startups and our own digital companies. And finally, I think, again, you've also said this, the definitions need to be grappled with so that we can begin to now clarify as well the growing difference in new definitional terminology.
We seem to have lost Laila. Okay, so she is.
Thank you.
Okay, thank you, Laila. Thank you so much for your time. Robert, if we could go to you next.
Thank you very much, Catherine, for this opportunity. So my closing remarks are generally, we understand this is a new phenomenon, and it's cutting across almost the entire world. One country or the other is trying to implement one form or the other. So it's a learning curve, and we will take time to get to full confidence where everyone is confident about how to go about it. But certainly it's a good, like Leila said, it's a good development, because we certainly do need to adapt to what is happening globally. We cannot remain behind. But then again, at the same time, it's also good to try and, because Kenya is also, Kenya is a member of the global economy. So we also need to follow what other countries are doing. So we, as soon as OECD releases the regulations, we probably need to adapt ours to make sure that they're in line with that. The next one, at the local level, we do understand the issue of turnover is critical. And like one person pointed out, the issue of turnover tax, because in Kenya, you only pay tax, a turnover tax if you have a threshold of 1 million or above. So this one does not distinguish that, and that I think is a very critical point. We need to make sure it's part of the regulations. But where your turnover is less than 1 million, then you're not expected to pay this. Otherwise, it will be a cost that you'll not be able to recover. And the thing is, turnover tax is 1 million. This is 1.2. Sorry, turnover tax is 1%. This is 1.5%. So that one is critical. From a VAT, again, the threshold is also important, because we know currently you only register for VAT if your threshold is 5 million. But the moment we do not have a threshold for all those who are required to register for this. So that's important. So thank you for the time and the opportunity, and we look forward to having more discussion. Thank you.
Thank you. And finally, Fred.
Thank you, Kate, and thank you to all the attendants. Just to avoid repeating what my colleagues have said, I think as Leila alluded to, it's a good development, because to me taxation of digital services is inevitable, given the trend that we've seen over time. Technology is really growing, and it was only a matter of time until government sought to tax any income that accrues from all this activity. But then that said, I think we need to do it in a proper, sustainable, and economical way. But it's not a simple issue, just going by the challenges and time it's taken. Even more developed countries and more able organizations like the OECD and the EU and the like to come up with definitive workable solutions to this issue. So it's an issue that we will take time to grapple with, and I think we'll get clarity as we move on. As you could tell from the discussions, there are issues on basic things like definitions and what they mean. But for now, we can only speculate and maybe try to understand based on experience and everything, but we don't have that clarity yet. I believe that will come with time. And then that said, my view on the VAT issue, I think it's welcome in terms of it will level the playing field. As Robert alluded to earlier, I mean, if you are a resident in Kenya, you'll need to register for VAT if you meet the threshold of 5 million per annum. But now you see the non-resident people who don't have PE, say would still be able to supply their services in Kenya without accounting for the requisite VAT, if they're taxable, that is, and then that would tilt the balance to their favor. So for VAT, to the extent that it applies basically to non-residents, as we've seen, I think it will go towards leveling the playing field. Of course, there are issues that we need to look at, like the issue of taxation of educational services, which are not taxable in Kenya and hence should not even be subject to VAT in the first place. Then on the DST, on the digital services, to me, I don't think there's need to levy DST on resident entities, because we already have mechanisms for taxing resident entities in Kenya, both under the main income tax and other taxes like turnover tax. Plus, as it's currently worded, this is advanced tax, which will eventually get to claim the credit against any tax payable. So I don't think it's that necessary, unless, I mean, one thing that maybe motivated KRA is it will widen their tax net, because it will bring maybe people who are initially not compliant into the tax net, and then KRA will be able to dig in and follow up on compliance even in the other tax areas like PAYE and the likes. So, but generally, I think it's an issue that will take time to get clarifications on the implementations and successful rollout over time. Thank you very much.
Okay. So thank you so much for attendees for being with us till the end. Thank you so much. And I saw someone raise a question on whether this recording will be available. This recording was being live streamed on YouTube, and so it will be available on our YouTube page. And you can also find other recordings that we did in discussing digital economy prior to this. And yeah, you could learn from that experience, as well as other entertaining and informative webinars that we have on our YouTube page. So thank you so much. Remember to tag us, and yeah, you can engage our panelists online. So thank you so much.
The world is changing faster than ever before. In the past 10 years, there has been an exponential technological evolution, the kind of technology that has revolutionized the world of work as we know it.
The Lawyers Hub was founded on the principle that law needs to interact more with technology, and that greatly affects tech policy as well as access to justice. So the Lawyers Hub exists as a confluence between law and technology, working on tech policy, on emerging technologies, as well as increasing and upskilling the knowledge of lawyers in the area of technology. We support tech startups as well to ensure that the tech ecosystem also engages in policy, but as well understand issues around data protection, issues that also concern their structure, as well as intellectual property.
If you look at the evolution of technology, It's been relegated as an alternative in most systems. But the realization that 21st century has brought us into is that technology has to be an integral part of our day-to-day systems. And if you look at some critical technology areas like artificial intelligence, blockchain, nanotechnology, biotechnology, then it gives us a strong indication that if we do not start having discussions on the use of these technology areas, as far as law is concerned, then we may be in some kind of trouble. So lawyers are busy leading the debate on the use of these technologies, especially in Africa.
Over the years, the Lawyers Hub has supported the innovation ecosystem, convened events such as the Africa Law Tech Festival and the Global Legal Hackathon. The Lawyers Hub has also supported government innovations within the justice sector, as well as trained government institutions and more than 10,000 lawyers across Africa on emerging tech policy.
Our dream at the Lawyers Hub is to have open access to law. We envision a continent where there is access to justice through leveraging technology and with a crowd of enlightened lawyers. We see a continent that also protects its own through better tech policies, that emerging technologies through its regulation will offer better value and consumer protection for the people within Kenya and within the African continent. We envision that we will convene policy makers, regulators, as well as lawyers who are more enlightened on emerging technologies and with better digital skills. And we invite you to be a part of this great vision for Kenya and for Africa.